So if somebody retires at 55, he is expected to live till 85, which is 30 years, which means you will work for 25 to 30 years and you will have to survive another 30 years with no earnings. For surveys which have been done in India, an average Indian needs 3.5 crores of retirement corpus to lead his retirement life peacefully. We'll give complete clarity about that in this video. Normally, the widely accepted or invested products for retirement purpose are fixed deposits, which comes number one. Then there are bonds. People invest in the RBI bonds. Then you have the senior citizen savings scheme, which is attractive in terms of a decent yield, a fixed return which comes from that. Then you have NPS, which is the national pension system, which provides decent returns over the long term. Then you also have mutual fund products, which most people who are in the retirement phase or people who consider retirement planning are completely blind about in terms of not looking at it. Or I can even say the only insurance oriented product needed in a retirement phase is a health insurance. Not just a health insurance with a super top up.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Normally, we tend to think the number of years which we work are the longest or longer than the number of retirement years. But if you look at the numbers, you probably will be taken aback. Even the current generation is expected to work for almost 25 to 30 years, starting from 25. Many of them would want to retire at 50, maybe some till 55, so which is 25 to 30 years. And equally, the number of retirement years can be at least 30. Which means I'm trying to get into the practical numbers. India's life expectancy today is 75 years. And we very often come across, and it's not very uncommon to see people who live till 85. So if somebody retires at 55, he is expected to live till 85, which is 30 years. Which means you will work for 25 to 30 years and survive with that money. And you will have to survive another 30 years with no earnings. It's really shocking. And now you will think whether I am saving enough, investing enough for a non-earning 30 years in my life. In many of your cases, and statistics say that more than 50% of people land up with an investment or retirement corpus, which may not be sufficient enough to run their retirement life. And now you think, if you're yet to be retired, how will you feel if you're going to be financially dependent on somebody for part of the retirement years or whole of the retirement years? How comfortable your life will be. And the retirement stage is supposed to be the most peaceful and less strenuous. And if that time, if your financial situation is inadequate and you have to be financially dependent, imagine how your peace is going to be affected, and if at all you will have peace. What's important to ensure that you have a peaceful retirement life? We will talk less about the accumulation phase, which is the year in which you will invest. That's this 25 years or 30 years. Simple, at least invest 20% of your income on a month-on-month basis. At least start doing that. Mostly you will be home with terms of the retirement corpus you will create. And as per statistics or surveys which have been done in India, an average Indian needs 3.5 crores of retirement corpus to lead his retirement life peacefully. Now, if somebody is in the phase of retirement, very close to retirement, or in the last faggot years of 5-10 years before retirement, which are the investments which he should know, invest, and which are all the popular retirement products which may be right or wrong. We'll give complete clarity about that in this video. Normally, the widely accepted or invested products for retirement purpose are fixed deposits, which comes number one, which may be bank deposits or corporate deposits. Then there are bonds. People invest in the RBI bonds, and of late there is also a dangerous sign of many corporate bonds which provide high yield, which are getting very popular among investors. People need to look at it very cautiously. Then you have the senior citizen savings scheme, which is attractive in terms of a decent yield, a fixed return which comes from that. Then you have NPS, which is the national pension system, which provides decent returns over the long term. Then you also have mutual fund products, which most people who are in the retirement phase or people who consider retirement planning are completely blind about in terms of not looking at it. So we will touch about all these products, which are the ones which you should consider, to what extent you can have in the portfolio, and how meaningful or what all purposes these products are helpful. So one area which we did not cover or mention is the annuity plans of life insurance. We will also touch that. Before we get into that, in the process of investment, people also consider the PF investments which they do, or the PF contribution which they do, and PPF also as products which are useful for them in the accumulation phase of creating a retirement corpus. These are how the products are. Very important. We only told about investment products. The most or the unavoidable insurance product which is needed, or I can even say the only insurance oriented product needed in a retirement phase, is a health insurance. Not just a health insurance with a super top up. Now let's get into the products which are generally used or should be considered for retirement. First comes fixed deposit. Fixed deposit can be a very large portion of the portfolio for somebody who has just created adequate corpus and doesn't have too much of a cushion or a risk capability in the corpus which he has, because it's very limited, just adequate. Such an investor may have to stick to largely fixed deposits, but he has to keep in mind, if the interest which comes is going to be within the taxable limit. Fortunately, now up to 12 lakhs of annual income is going to be tax free. So large number of investors in India may not have an interest income of more than 12 lakhs coming in a year. On the other way, at least people who are currently in the retirement phase, except very small portion, many of them may not need a monthly expenditure of may not have a monthly expenditure of more than 1 lakh in a month. So in such a case, FDs may be good because they really do not have the risk appetite. In the FDs front, they need not keep everything in a bank FD. They can keep at least 30%, 40% in corporate deposits, because when a large bank, if you take a large PSU bank or a private bank, or the most reputed banks, today the interest rates for a senior citizen may be somewhere around 7%. But the moment you look at a corporate deposits, again, corporate deposits which may be AA plus or AAA in credit rating, only that is the credit rating which you can consider, not a single notch below that. Such FDs of corporates also give you almost 1 to 1.5% more than a bank deposit. So you get 8.5 from these deposits, 1.5% more than a bank deposit, and also really safe, right? Mostly you may have to stick around this. The more you have as a corpus, which means if you have 15-20% more in terms of the corpus required, or if your corpus adequate requirement is say 3.5 crores, and you have 20% more, which is about 4.2 crores, you can take a little more risk. That's possible. Where do you do that? You probably can look at this amount, that extra amount, to be parked in balanced advantage funds or multi-asset funds or mutual funds. So these products actually don't have a fixed return. They have market risk. They are not completely equity funds. They have a mix of debt. Multi-asset funds have even gold and silver, and also other than domestic equity, they also have global equity exposure. And one good thing about these products is they reduce and increase the equity exposure based on the market valuation on opportunities. So which means the customers need not worry much in terms of the equity exposure, because the fund manager himself reduces the equity exposure when the risk is very high in the market, and when the opportunity is high and valuations are attractive, he increases the equity exposure, which also generally doesn't go more than 50-60% in a balanced advantage fund. In a multi-asset fund also, you have funds where the domestic equity exposure is just between 35 to 65%. So this is how you see the equity exposure, but these don't give a fixed return. Be very clear. But on a long term, if you're investing for a 3-year plus period, these funds can give a potentially 10 to 11% return, which is almost 3% more than what you get from the deposits. Here also, you have an option of taking out money monthly as you take in an FD in the form of an interest. In these funds, you invest for 1 or 2 years, you probably shouldn't touch it. And after 2 years, if you start withdrawing, the withdrawal is possible and can be automated in a mode called systematic withdrawal plan. So how this works, you invest in this scheme. After the moment you start withdrawal, you give a standing instruction. saying I need this amount of money to be credited to my account on this particular date every month, and your accounts get credited accordingly month on month. How do you start withdrawing from this? Maybe if you are investing and withdrawing only after 2 years, probably you can look at 7 to 8% of withdrawal from it on a monthly basis, which means 8% divided by 12 and or 7% divided by 12. Provided you are withdrawing only after 2 years, you can look at this as a withdrawal and the money keeps coming in to your account. But in case markets fall, like the COVID time when markets fell 35%, you may have a drop in the capital, provided, and particularly if it is in the early years of your investment. In the later years, if you have a fall, and in the earlier years, if you really did not have so much of a market fall, the chances are still you may not have a drop in capital. But based on market fluctuations, there may be interim drop in capital, but over the long term, this can also be covered. Mind you, here you may withdraw only 6 to 8%, but the overall returns which you make in a longer term is 10 to 11%. So one important thing, as we talked about taxation in the case of FDs, here and in the case of FDs, the moment you cross 12 lakhs in a year, based on whatever is your income slab, 5, 10, 20 or 30% based on your tax slab can be your tax paid to be paid in terms of FD interest. Okay, the same is the case if you invest in a debt fund, even if you invest in a corporate FD, and even if you invest in a bond. Whatever is the coupon paid, that's how you will pay the tax. But in a systematic withdrawal plan, any withdrawals done after 1 year and on the units which you draw, only the gain portion is taxed at 12.5% only. On top of that, you have an advantage. All these long-term capital gains up to 1.25 lakhs in a financial year is tax-free. Only if your gains are more than that, you will actually have to pay taxes. That's again only 12.5%. And be clear about one thing. In case somebody withdraws 1 lakh in a year from this, and which means in a month, and somebody withdraws 1 lakh in a month from this particular funds, at the end of 12 months, you would have withdrawn only 12 lakhs. So in the earlier years, on a 12 lakh income withdrawal, your gain portion mostly maybe only 1.25 lakhs, the gain portion alone. So which means you may not have to pay tax. Only in the later years, you may exceed 1.25 lakhs in a year, and the excess around you pay 12.5%. So which means it's very attractive on the taxation front. Let's look at RBI's bonds. So these are bonds which have a floating rate. It's not fixed. Every January and July, the rate will be adjusted. Currently, it is 8.05%, which is not fixed. When the next revision come in July, in case there is a reduction in market interest rate, the rate can go down, right? And the returns are taxable. As we told you earlier, based on your tax slab, if it is 30%, you will have to pay 30% tax on whatever is the interest paid to you or coupon paid to you from an RBI bond. In an RBI bond, the interest is paid once in 6 months. Then you have senior citizen saving schemes, which today offer 8.2% interest, which again is not fixed. Based on changes in market interest rate, the rates may go down or go up. And let's think about one broad reality. India is a emerging nation. It will only graduate to be a developed nation. In that journey, the chances of interest rates going down is much higher. So investors need to be prepared for the interest rates in the future likely to be lesser than what you see today. Now let's come to the senior citizen savings scheme. The interest here is paid quarterly and the interest is taxable. You can invest up to 30 lakhs and the interest rate is taxable. So all these bonds and senior citizen savings schemes, the interest rate is taxable. What comes next? One interesting product which is emerging in a very healthy manner, innovations to market current standards and really promising returns for somebody who's willing to take that extra risk. This product actually comes very handy. National pension system, if you invest in the equity option, today you have an option of investing up to 100% in equity, which used to be only 75% earlier. And in an equity option, in the long term, you can get 11 to 12% as returns. Mind you, there is also an active choice and auto choice option in NPS. And somebody who's looking for maximum tax exemption, you will have to look at the Tier 1 option. In the Tier 1 option, even today, even in the new tax regime, you get tax exemption, which means up to 14% of your basic, which is contributed to NPS through your employer, is exempted every financial year. You make 11 to 12% return if you invest in the equity option. If you are investing in the auto choice option is where you don't decide the asset allocation in terms of how much in equity, debt and government securities. There it's auto. How auto choice works is, auto choice in the early years will keep your investment predominantly in equities, and in the latter years your investments predominantly will be in government securities and corporate bonds. Corporate bonds can give you 6 to 8% return. The equity option can give you 11 to 12% return. What's even more interesting is, had you chosen to be mostly into the equity option, you would have got 11-12% annualized return. And while you exit at maturity, today maturity also has a change. Earlier it used to be 60 years only or later, but currently after the recent changes, even if you have completed 15 years, however early it is, after you have completed 15 years of duration, you can exit. If that is not the case, then you have the option of exiting at 60. And you still have the option of staying till 85 also. You can stay till 85 in NPS, and when it matures, you can take out 80% of your money as lump sum, and of the overall money, 60% is tax-free. You can take out 80%, but only the first 60% is tax-free. The rest 20% is taxable, and you will have to necessarily buy an annuity plan with the balance 20%. Only that is going to be taxable when you get that annuity. Because we have touched about annuity, let's also try and again insist and emphasis. NPS is by far one of the best retirement products available in India because it has tax exemption while you invest, and it also has 60% of your investment tax-free when you exit, right? And it's very flexible. You can invest in any option, any mix of any options. You can have multiple schemes. You can have asset class exposure across equity, corporate debt, government securities. You will also have the opportunity to have a mix of REIT, InvITs, alternate investment funds. All this are available through the NPS option. You don't have any such option available in India which gives 60% of maturity as tax-free. So it's very attractive. We also talked about the annuity plan. You also have standalone annuity plans in insurance. There are many investors who get attracted by this because it's of an insurance company. The safety feel or safety comfort is generally high with an insurance plan. But what many people miss is the returns which you get from this is hardly around 6%. You get only around 6%, and it's very important. It is taxable. If you are on a taxable income slab, then based on your income tax slab, it can be as high as 30%. And you can also have surcharge if your income is extremely high, more than 50 lakhs. Then your taxation is going to be very painful for such a small yield of 6%. The gross yield of 6% is itself only equal to inflation, and your net yield after taxes actually falls below inflation rate, which is very unproductive and useless in investment. While we say about all these products, PPF traditionally is also a very respected debt product. A decent return, generally more than a bank FD. So today a normal citizen gets 6.5 from a bank. A PPF pays 7.1%. PPF is locked for 15 years. While you can take a loan against it, you can have partial withdrawals. All this is possible, but otherwise the capital is locked for 15 years. Decent return amongst the debt products. Very powerful product in terms of the security fencing of this product. Even a court of law cannot attach your PPF investment. Even if you are indebted to somebody, the court of law even cannot attach your PPF investment. It is such powerful investment. One thing which was not listed so far is the other life insurance products, which also are presumed or sold as very great retirement beneficial products, which means we are talking about traditional plans. It's less ULIPs that are sold as retirement products, and it's more the traditional insurance plans which are sold as retirement products. And it's a myth. Please don't consider them and take your thought of an insurance plan working as a retirement product just out of your mind. It is not at all. The reason, the pitch or the projection which is given in terms of the absolute amount which you receive. While you were investing for 20-25 years, it may be 15,000-20,000 rupees a year. And when somebody says, after 25 years, you get so many lakh every year, it sounds as though the amount which you get is much larger than what you're paid. But the fact is not that. What you need to look at is the return which you get in percentage terms is hardly around 6%. Such long money, such long investment of 20-25 years can easily afford a risk of fully equity or a partial equity exposure and give you a 10 to 12% or even more returns, which you are compromising just for the sake of the fixed or guaranteed tag. The guarantee comes at a very high cost of eating into your opportunity and potential returns and gives you just 6%, falling short of inflation. Completely unproductive, overrated, and over pitched projected kind of a product. This doesn't suit you for retirement. There are also people who have treated or who consider property as a retirement benefit product, means rent. And actually speaking, other than the house you stay, in a retirement life, ideally you should not have any other property, particularly if you are expecting that to be a retirement benefit or a product or a property which will give you money for your monthly expenditure. Don't treat that as a retirement benefit product. The reason being, if you look at the yield, rental yield means on the cost of the property, if 1 crore is the property value, what you get as the return in terms of the rent, that is called the rental yield, in a year in India is not more than 2.5% on an average. On a 1 crore investment, property investment, you just make 2.5 lakh only in a year. That is approximately 20,000 rupees in a month. Had you invested in a conservative hybrid fund, it can give you about 10%, which is 4 times more than this. Why I'm talking about this? People may talk about the capital gains which may come in a property. Mind you, you are holding this as a retirement product to feed you every month, and you are definitely not going to sell this for you to get benefit of the capital gains. So what you get while you live every month is very important. That way, property gives you only 2.5%, and you know the pain of managing a property in terms of maintenance, in terms of managing a tenant, getting a new tenant, right? There are so many painful things which can happen in terms of property maintenance, which is even more painful to handle it during your old age, correct? So please don't consider that. Accept the property where you stay. In case you happen to have another, while you retire, sell it off. Even you put it in an FD, you get 7%. If you are a little smart, if you can take a slightly higher risk, you can get 10% from a hybrid product. This is how you should look at retirement in terms of the products and investment products which you can invest. I told you something earlier. I would end with that. The most essential product or the only insurance product you have to look at is health insurance while you are at retirement. Don't at all consider any other insurance product for your retirement if it is sold to you as a right product for your retirement phase. Never. It's only health insurance which you need. The health insurance can give you cover pretty up to 1 crore. There are products which gives that. And even if you are not able to afford a big base policy, base policy has higher premium normally. If you are able to take a 15 to 20 lakhs of base policy, which whatever is the base cover, you can take additional 25 lakhs or 30 lakhs through a super top-up policy. Then comes into relatively lesser premium. And if you are somebody who's yet to be retired, if you are working for a corporate, very often we may have only the corporate provider health insurance policy. Please look at taking an additional policy in your individual capacity, not depending only on the policy which you have for your corporate, because the older you go, you may unfortunately happen to have illnesses. God willing, if you don't have, it's good, but practically if you see people, once they get older, they get more illnesses. So after retirement, until then you had the corporate policy, and at the age of 60, you approach an insurance company for a health insurance cover. In case you have health complexities, the cover may come at a very expensive premium, or there's a chance that insurance company may completely refuse to take you or cover you, right? That's a high risk. So even if you are 30 or 40, don't depend only on your corporate policy. Even at 30, 40, take your individual policy, because you are generally healthy then, and so you will get your cover at a very low year. So this is the only insurance product which you have to take as early as possible in your life and carry on throughout your 99 years at least. And please keep in mind, after you take your policy, of course, after 2 years, 4 years, you have your pre-existing illnesses also covered. After you take your policy, any fresh illnesses you are affected with absolutely may have no impact on your policy, and that all have to be covered by the insurance company throughout your life. And please ensure you renew it every year. So these are the thumb rules. These are the discipline which you will have to follow, the do's and don'ts which you will have to follow. And if you can follow this, you can have a peaceful retirement life. You can get decent returns. You can reduce your tax burden. and live your golden years with golden spirit. I'm sure we have given you all the broader information required or essential in terms of identifying products. Now, if you want to put all this together in a very structured manner and to be monitored and maintained throughout the years, we are there to help you, and we will see our contact details below. Please contact us and we will help you with customized retirement planning services, and we will be there throughout your life, monitoring your investments, doing necessary changes, and particularly safeguarding your investments.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.